Cole Wilcox, what are managed futures and why is now a good time to be in them?
Managed futures is an asset class that trades four major sectors: currencies, commodities, equities, and interest rates around the world. So about 100 and some odd markets. Long and short, so you have opportunity to make money when markets go both up as well as down.
And which commodities are in your fund? We've seen things like corn really spike because of the drought. So how much corn, for example, is in your fund?
Right, so as a trend following strategy is the predominant thing underlying what it is that we do. We're always going to be long markets that have huge breakouts like the grain complex. So we're long corn, soybeans, things of this nature across the entire grain complex. We've had a great month. I think half our profits this month are coming directly from that sector.
And what makes your fund different from other funds in the market?
We're unique in the sense that our strategy is inside of the mutual fund and you're coming directly to the manager. So we control all the internal trading. We do not allocate under sub-advisors. So you get cost savings as well as direct access to the manager and transparency into the strategy and direct relationship with Longboard.
And speaking of cost, how much does it cost? Is it expensive? Because there must be a lot of trading involved.
Our strategy is actually ultra long duration, so our average hold time tends to be in excess of 1 year on a position. The reason our firm is Longboard is we're trying to capture those big wave distributions, and the Longboard is a tool for capturing those types of waves. In our case, from a cost structure in fees, we see coming directly to the manager, removing the typical 2 and 20 structure of a hedge fund, and also removing the other side of it with the fund-to-fund structure, where you can come directly to the manager and get a substantial cost savings by working with us.
And how risky is it?
Risk for us is defined, as sort of a standard deviation or volatility within inside of the portfolio. We tend to target the fund to be something in the 10 to 12% returns, 10 to 12% annualized standard deviation, and to be non-correlated with the market. So our strategy can be actually a massive risk reducer for a traditional portfolio, since we tend to zig when your other portfolio zags during market stresses and times of crisis.
All right. When one person considers their portfolio, how much of your particular fund, a managed futures fund, should they put in their portfolio? 5%, 10%?
Yeah.
Put it all in there?
Well, for me, I put it all in there. But in terms of the kind of looking at the math and building an efficient frontier in your portfolio, historical research using sort of the managed futures indexes that exist out there. I think the CME did a paper, 25% allocation. If the base portfolio was a 60-40 standard stock and bond portfolio, would have achieved the sort of historically over the last 20 years the best risk-adjusted return in the portfolio.
This market has fewer players.
We're coming into a Monday where we're going
would enter in a new stage at SEC.
It's a stock picker's market.
Welcome to the 5 dumbest things
Apple
on Wall Street.
reported earnings.